Gold, silver, copper, all on the move, and commodities are looking to do well. Tavi Costa joins us today and goes over these things and more on this episode of SBTV. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira, part of the outreach team of Silver Bullion here in Singapore, where we want to help you truly secure your wealth. Tavi Costa joins us today. Tavi is a member and macro strategist at Crescat Capital, and his research has been featured in financial publications such as Bloomberg, the Wall Street Journal, Reuters, Yahoo Finance, just to name a few. And we're delighted to have Tavi join us once again today. It's time to saddle up and silver up for Tavi Costa. Tavi, welcome back to SBTV. How are you doing?
I'm great. How are you, Patrick?
I'm doing great. Glad to have you back on. I've been seeing a lot of your tweets and your Crescat Capital live calls. So I'm going to be using that as a reference so we can get that out to people. A lot of great info there. So appreciate that. So I'll start off with a recent tweet you put out. You noted the remarkably high Swiss gold export to the U.S. Can you touch on this a bit for us?
Yeah, there has a big change recently that we're seeing in regards to this gold rally. And I think that the initial phases of the gold appreciation that we've had going back to the pandemic levels was really driven by foreign central banks initially. We did see a lot of Chinese money coming in. We did see a lot of Russian money, but also other countries that are part of the BRICS. So it wasn't just Eastern societies, but they tend to have a better understanding of monetary systems just because of their need to. Not that Americans don't. It's just when you're living in a world where monetary stability is the thing you wake up thinking about the most. And I can speak for that because I was born in Brazil and currency volatility was just part of your life. Inflation is part of your life. And so you're constantly thinking about how to protect that. And the mindset of Americans is very different. Now, what changed more recently that I've noticed is that from a flows standpoint, if you look at all the gold vehicles, gold related vehicles, or vehicles that are out there for investors to buy and get exposure to gold prices, what you're going to find is that the flows of those instruments in the US and especially Western societies have been on the rise. So you're certainly seeing inflows in that front as well, which makes me think that this last rally was much broader driven, geographically speaking, than the prior ones. And to me, this is very meaningful. It's incredibly meaningful because I think we're at the beginning. There are talks about revaluation of gold, being asked to Scott Besson. Clearly Scott Besson, his largest position in his hedge fund was gold before taking the Treasury Secretary role. You have further escalation of geopolitical issues. Still forcing countries to own gold themselves. So lots of changes there, and that have been, I think, forcing gold prices much higher. This is one of those times in history where, I do think you want to be careful with technical analysis. Technical analysis will put you away from this, steep appreciation that we're seeing. And if you have a revaluation, call it 1,000. Now, I'm not saying we will, and I'm not saying I know what price is going to be, but let's just assume it's 3,500, or more. What does that do, to your technical analysis? I mean, you can throw out of the window. I mean, it doesn't work. It's just there is a revaluation, and you're gonna deal with it. So, it's one of those times in history that really don't happen, very often. So it's exciting and for gold investors, in my view. And just to finalize my thought, I think it's incredibly bullish for the derivatives of gold themselves.
Yeah, Tavi, because when I saw that chart you put on Twitter, I mean, it looked definitely like some type of a outlier, an anomaly almost compared to everything else that was on that chart. So I just wanted to touch base with you and see, coming off the back of what we saw in London with all that gold moving to the US, and now we're seeing this with the Swiss. I just wanted to get your thought on all this gold movement.
Look, I don't have insights on where, what's causing this bar, and honestly, I don't think anybody does. I think that what's been happening with the Swiss gold exports is, there are other things that potentially are causing questions here. I mean, what's happening with the fortknox audit that we're hearing as well. I mean, this is all related to the same issue. Finally, people are waking up. I said this in a tweet a while ago, and I really meant it. It feels like we're having a history lesson about gold, happening now, and it's some people that have never focused on gold prices are finally paying attention to, and maybe that has something to do with folks that have invested in gold bars that are staying in Switzerland and now are basically calling those back. And I'm sure there's some of that, but I also think there's some of potentially of this the fortknox audit is a big question to the whole system. I mean, I can go both ways on that question, meaning do we have more or less than what's been reported? And what's the meaning of those two? If we have less, clearly this is very bearish for the US dollar. I mean, that would be a big movement in the market for sure. And I'm not
Yeah.
suggesting there is. I mean, I really don't think anybody knows anything about this. It's just a matter of, once the truth comes out, we're markets are going to react accordingly. The second way you could go is, what if we have more? What if the U.S. has been accumulating gold and has been part of this movement on the upside? Would it surprise a lot of people? It wouldn't surprise me at all. I mean, that would actually make sense. What would that do to the dollar at that case? What would that do to gold? That means other central banks are really desperate, especially the U.S. And being part of this rush to accumulate gold. So yeah, these are all meaningful scenarios that could change markets, like that, and we need to pay attention to. But what is really interesting in my view is, and I'm not trying to shift gears here, but shifting a little bit. When I look at things like, and I know I've been talking about this, and I've been following silver for a long time, but there are times when you really want to focus on it because we're about to see something, and there are two derivatives of gold prices that I think are on the brink of moving substantially. One of them is silver, of which has been acting like it's about to do something. And mostly, we had a price action on Friday that was interesting. Last Friday, prices went up a lot. I think it was up 4.5%, 5%, and then closed down. I mean, this was a huge fading action in the markets that usually is accompanied by further downside in prices. And we just ignore that. We completely ignore that. There was a head and shoulders pattern. We ignore that too. Silver is just charging higher, and people are not paying attention to it. I mean, the people that follow markets in the precious metal space, sure, but overall, people are not looking at it. And I think this is the type of market that you tend to see those gap, increases, very, very quickly. In the course of, we're approaching the end of the quarter. It wouldn't surprise me at all if you close the quarter at $40 an ounce, and $40 is not that much of an increase. It could go up to 45, and this would be a very meaningful quarterly close in the chart. It would essentially, I believe, it would be a all time highs on the candle chart on the quarterly front. Obviously, we saw higher prices, 50 and so forth, but on the candle chart, it would be a very important close. It wouldn't shock me at all. I think we're about to see that.
Yeah, completely agree. I one thing I know for sure, there's going to be a lot of movement. Can't tell you which way it's going to be, but I also am pretty sure that whatever they do with Fort Knox, whatever that tally was supposed to be, it probably won't be. But higher, lower, we'll find out. But Tavi, in one of your recent live market calls, in your research, you noted that in a survey, inflation may be on the uptick. Can you tell us about this?
Yeah, I think 2 to 3 weeks ago, you had mixed signals on inflation, uh, and you had commodities broadly going higher, and we had a few other metrics that were not confirming the inflationary trends, and mostly not even government data, but mostly if you look at the dry Baltic Dry Index, for instance, which is a good indicator, it has not been going up. You look at shipping cost has been falling as well. So all these things are have been going on a different direction from broad commodity prices. And so I was watching that very closely because I wanted to know which one is going to be right here. I had a view on inflation reaccelerating, but obviously I was respecting those other data points, and I think inflation is gaining momentum now. You can see it on the break-even rates. If you look at the break-even rates, which is the market expectation for inflation and different durations, particularly the short end, like the 5 year and so forth, you're seeing a big spike of those numbers. And interesting, if you chart break-even rates, again, inflation expectation versus the 10-year yield, those two things in the last year or two have been following each other, almost perfectly. And in the last few days, we've seen a very significant separation between those two charts, of which makes me, leads me to the conclusion that the markets are starting to price in stagflation. And we're probably at the early stages of that. And you can see this in the retail sales number that came out last week. I think it was by far the most important data point we saw last week in terms of macro data. This was a 10% annualized decline. 0.9 on a month over month. I mean, this is very significant. I mean, this is a 10+% decline. I mean, this is something to be aware of because you're seeing a decline of nominal retail sales. I mean, we know there's inflation there. Like, so how much of a contraction of economic activity are we actually facing? So, that number needs to be studied. That's certainly something that I think gives me more conviction to think that we're closer to a stagflationary period. And lastly, what I would say, if we are, one of the best things to look for in markets, and people that know how to read the market in terms of macro data, it can be very helpful to understand if we're about to see things, either break or the potential for a volatility event. I do believe we're very close to one again, and the big reason for it is if you look at the corporate spreads in the junk bonds market, we're at about 2.5%. So what is that? So that's basically looking at the lowest rating of a company and accumulating all of those, seeing how much they are borrowing money for, and at the same time, look at that versus the spread with the U.S. Treasury at the same duration. So supposedly risk-free rate. I know people will say it's not risk-free. I'm just using the term of the market, so don't go after me. But if you look at that spread, it's below 3 for about 100 days. We have only seen that once, at least in that I was able to find in history, and this was in July 2000 or June 2007, which was a month before the vol event that started with the global financial crisis. So I would suspect we're close to something here. We're very close. Be careful with timber is around, dry timber ready to catch fire, and I would be very careful here with the overall equity market right now.
Interesting, you mentioned stagflation. It was a word we heard, maybe a year or so ago, a year plus, and then it's coming back. It's coming back again. So, uh, What was interesting though was in that presentation also you noted that the Magnificent Seven enterprise value versus GDP, of course, Magnificent Seven, Alphabet, Amazon, Tesla, Meta, Nvidia, Microsoft, Apple. Is this a good thing or perhaps not a good thing to have so much of the GDP weighted against these stocks? And especially now with stagflation perhaps around the corner.
Yeah, but look, I think, again, we always have to look back to things to see if we've seen something similar in the past. And my research shows that concentration doesn't end well. And although these companies make money, and some of them are very profitable, the price you're paying for the profitability in some cases is quite absurd. You're talking average probably of Mag 7 at about 35 times earnings. So, this is very, very extreme. If you look at the Nifty 50 bubble, for instance, I think those stocks were trading at 25 times earnings, and that was a bubble. So people have lost notion of what a frothy valuation looks like. You hear people on TV saying it's only 30 times earnings, and it's like, man, this is I mean, we're talking, a quite extreme number. How can you say just before saying 35 times earnings? I mean, this is, not the case. And so, look, there was a good research recently put out on Twitter that I saw that I think it's relevant for the discussion. That every time you see, the CAPE ratio above, the 30s or so, and you look at the performance for the following 10 years after it reaches that 30 plus CAPE ratio. What's CAPE ratio? Is a cyclically adjusted PE ratio of the US equity market in this case. What you find there is that the performance is very poor. Most of the performance comes leading up to that 30. And at the post era is it tends to be, the bust moment. We are in a different environment in regards to money printing and expansion of monetary base and other types of measurements that have been used since the global financial crisis to avoid a recession and so forth. I still think that there's really two routes we can go here. I really don't believe the concentration in the market is sustainable. So we have to think about, does that cause a crash? That's one alternative. Or the second one is just a peaceful rebalancing to other sectors. That could be the case too. We can certainly see something along those lines. Usually, we tend more to see the crash scenario. But that could certainly be the case that we may see just a peaceful rebalancing into other sectors. So I'm open-minded to both, but I don't think the concentration is going to last much longer. I think we're at the end of that.
Okay, yeah, I guess using that word rebalancing, I mean, I guess I want to ask you about gold and the miners. Are they doing better? I mean, with the price of gold going up and the miners, with their cash flow doing better, maybe their earnings are doing better. Are they still undervalued?
I think it depends who you ask. If you ask people that don't do their homework and all they do is just look at the GDX index or ETF, their answer would be they are not doing very well. But if you do your homework, or maybe you were one of those people that actually own a private mine or something along those lines, your answer would be, I don't think I've ever seen a better time to be mining metals, especially gold. The production margin is substantial. We're seeing some of the largest margins we've seen in history. People are not paying attention to this at all. The private market is actually very, I would say, competitive right now. There's lots of competitive landscape in terms of trying to, we've been in the business of trying to acquire some of these private mining companies, and operating assets have been under a lot of demand in general. And so I think that we're, my I suspect that, as I said earlier, that the derivatives of gold are about to have a move, and the miners fall into that category. The miners have been acting very well more recently. We're starting to see the exploration companies have big days up on their own, sometimes without any news, and that's a sign of the market, coming back. That you've got mining companies really have, sort of two currencies in their hands. They have cash that they can hold and they can generate through operation, or they can raise through dilution and all sorts of things. But cash is king for them. And secondly, is their shares, right? It's the shares. If they go higher, they can dilute in a more optimal way, but also raise capital to do acquisitions and so forth. We've seen a few acquisitions recently, which is a good sign of the mining industry. I think we're going to see a lot more of that because companies are making money. That leads to more decisions or in terms of the M&A activity. And I really think we're about to see more of that, not less. And that's usually what drives the cycle for mining. So we did see some start of that in the past few years, but gold prices were not really taking off like they have been. Like gold prices could be down $500 or so, and still you have a huge margin. I mean, my calculations that most of the miners are probably, of course, there's unique cases, but they're mining at about 1,500. Gold prices at 3,000. Like we're talking, double that.
Wow, no, that's a good number to know. And yeah, I was just going to ask you about any mergers and acquisitions if you see more of them happening this year, and I guess you answered that. So I want to touch on the history of gold cycles a bit. We had them in the 70s to the 80s. Then we had them in 2000 to 2010s, and here we are again today. Looks like another gold cycle is happening. But I want to ask you, what can you tell us about the similarities or differences in these cycles?
There are some differences and a lot of similarities. I think the differences are back in the 1970s. The big one was that we're in an inflationary cycle, and central banks were buying gold, and I think the similarity from other cycles is that production was falling. Now, a lot of people say production doesn't matter and so forth, but it just happens to be the case that production was falling in each one of the prior cycles. So I pay attention to it for sure. Then we had the early 2000 cycle, of which wasn't really that classic inflationary era. We didn't see much, particularly from a central bank standpoint, right? Central banks were not really fighting inflation like they were back in the 70s. I think that's the most important thing. Secondly, we didn't also have central banks buying gold. That was a big difference. In fact, some of them were sellers. I think there was net selling in that period. And so that didn't really drive gold prices. What the big driver of that time, in my opinion, was the rotation out of equity markets because markets were too frothy. But secondly, also the turn of the U.S. dollar. We did see the dollar finally peaked at that era in the early 2000s and enter a long-term bear market, of which trigger a lot of other things. And so I think all those things, but the other important one was China really, entering the WTO, becoming the manufacturing plant of the global economy. All those things certainly played a role in commodities overall, right? Gold went up, copper went up, silver went up. I mean, everything that was metals related went up, and so that period was a period that was very bullish for metals overall and commodities in general. So, but very different than the 1970s. What I think is happening today, however, different from those eras and some similarities. What are the similarities? We have central banks buying to a pace that we haven't seen probably in history, particularly if we're including official data, because official and unofficial data, because we're all looking at official data. Who knows what's happening? Like we're just talking about fortknox as a conspiracy thought, but really, what if, right? And an actual official data of buying from central banks is much higher. It could be the case. We don't know. So I've done some studies on this as well, looking at how much we've had of a gold price increase and how much has been reported of of central banks purchases, and the number doesn't add up, right? I mean, there has to be some other unofficial buyer driving the prices significantly higher, because that's not enough to take gold prices double, as we saw over the last year. So in my opinion, putting it all together, this is interesting because we're also having, China was basically doing their own onshoring. They're basically investing in manufacturing capabilities and so forth. And I think we're seeing the same, but not really driven by one country. We're seeing this across, at least the G7 economies are very focused on bringing manufacturing back and focused on reducing liability dependency on China. So clearly that's also a trend. We have frothy equity markets, which have the likelihood of driving another rebalancing or rotation out of those markets into gold. And there are other clear signs as well they're very similar to those other eras. The market cycle for gold usually is aligned with other cycles. You tend to see miners do very well. You tend to see other metals, but there's another one that is kind of out of that, normal correlation that tends to perform very well, which is emerging markets. And emerging markets are really cheap today. If you look at the American exceptionalism and how much a company is being valued in the U.S. versus in an emerging market economy, we never see the spread be so large. And so I would suspect that those things are also on the verge of moving significantly. And so it's a big focus of mine to be looking at emerging markets, because I think they're going to be part of this new gold cycle. And lastly, which we didn't see in the 70s and early 2000s, to continue answering your question, is the debt problem. All right, I mean, it's the big elephant in the room. I mean, it's the debt problem. Let's just say Doge, is able to save, $2 trillion of deficits. Okay. That's additional debt that we're talking. We're not talking about reducing the debt. We're just talking about not increasing the debt at a crazy pace, right? I mean, things have been twisted recently. We're not really saving money to pay down the debt. We're actually, just not increasing it, which is insane when you think about it. We're not running a surplus at all, right? So that's, to me, that those are the big things that have been sort of I think have been kind of underreported in the market by the media. That certainly have a big role into driving gold prices significantly higher. Not to mention the 60-40 portfolios as well that remain really under allocated on the metal.
Silver to gold ratio, we're still at about 90ish or so. How do you see that moving? And also, I want to ask about copper. Is there some correlation between copper and gold?
The gold to copper or copper to gold ratio is also extremely undervalued, meaning we're seeing one of the lowest numbers in history as well, of which I think it's unsustainable. Given especially what's happening with AI and onshoring and the electricity consumption on the rise, it's hard to believe copper will be trading at these levels. And I think we're going to see much higher levels. Difference certainly is on the supply side of copper versus silver. Supply of silver is extremely constrained. Copper, not so much. There's definitely copper out there. It's just a matter of prices. If prices are high enough, those deposits become economic. So it's not a supply issue. On the other hand, when you look at silver and gold, supply has always been the issue. Finding new discoveries and developing those discoveries into a producing mine has been very challenging. And so it's why I tend to be more bullish on those metals than others. But I think it's going to lift all boats at the end of the day. And what gives me the conviction that we're about to see a big pop in silver prices is because a 90 gold to silver ratio is absurdly high. And who would have thought we would have a 90 handle with silver prices approaching $33-$35 an ounce? I mean, I can raise my hand saying that I did not see that coming. So And I don't think anybody else did. So that does that mean silver is going away? I don't think so. There's a very interesting research I was looking. I didn't post this, but if you look at the industrial companies and do a chart of that versus silver prices, the link that they had over the last 2 years have been, very close. Of which, if you think about the new administration forcing industrial capacity and the increase of that as a big role into the U.S. economy, you would suspect that silver can also benefit tremendously. Not to mention solar panels and other things that can play a role into rising demand for the metal as well. So I think people are also about to learn a history lesson about silver here very soon.
Yeah, Tavi, last question here. You mentioned artificial intelligence. Where do you see this new race taking the markets?
There's a lot of interesting takes on this. I'll try to give you a unique one that I've been thinking a lot about. First, I think the DeepSeek development certainly added little bit more wood to the fire of this race, and put into perspective that the U.S. is not, winning in all fronts, of which gives just increases the level of competition that we're seeing. Um, I think there's a real push from the government side to make sure that we meaning America in the U.S. economy wins in that race. They're going above and beyond on spending, which goes against the whole idea of saving on fiscal stimulus and so forth. So clearly, there's a huge push of finding liquidity, from different fronts to make sure those developments continue. What I find it interesting is the whole research regarding electricity consumption and where the electricity will come from for those things. I think there's going to be something that not a lot of people are paying attention to that might be the case. When you analyze some places like in South America, for instance, they have been producing more energy than what they actually consume, and which is not going to be the case here in the U.S. I mean, we're about to see electricity consumption maybe even triple, depending on some numbers that I've seen. And so, there's going to be a need for seeking those economies that have access of energy to potentially be ones that you can partner with and build databases in those areas. And so I think we're going to see that. I definitely think that's going to be the case. It's sort of, I wouldn't call it a no-brainer. Of course, there's jurisdiction risk and all sorts of things, and I'm sure they're not going to move completely to those areas. But if there is, a solution that is open, usually capital will find its way into those solutions. And so I would suspect that Brazil, Chile, Argentina, and some others may actually be benefiting from that. I mean, Brazil alone is 60% of its energy comes from water. So of which the country's blessed with a lot of rivers and all sorts of ways of producing energy. And so I'm just using that as an example. There's other countries that are in similar positions, but they don't need that much energy. In fact, there's there's a true excess of energy in those places. So if you can, you have a company like Mag 7 companies completely hungry to use that energy. What do you think it's going to happen? It's going to be a clear path for those to start developing there. And then what does that do to their economy? Obviously that's very positive. It's very, very positive. So it's a lot of things to think about, but I do believe that emerging markets like Brazil may gain a lot of momentum in this whole front. Not to mention they also have a lot of raw materials that can be used for data centers and others.
Yeah, great point. Great point. Tavi Costa, you've given us a unique view on things based on research, and we appreciate that greatly. Can you tell us how we can follow you and get more of your insights and see more of your work?
Sure. Well, thanks for having me, Patrick. Again, you can always follow me on Twitter at Tavi Costa or X, and also LinkedIn. If you just type my name, Tavi Costa, I'm sure you'll find it. And I usually post it almost daily, analysis and ideas and charts. And If you're interested in those, suggest you to look at those.
Okay, and your Crescat market calls.
Crescat.net is the website. You're welcome to look at our letters. I'm working on one right now. We should be putting out hopefully in a week or two. But we also do a live presentation. We usually do every 2 weeks. More recently, we've been doing weekly because of the market relevance. So that's basically why we've been working on this. But I think it's a great place if you're trying to learn about geology and learn about the geological thesis behind investing in an exploration company. I think it's a great place, but also to hear our recent macro views as well.
Yeah, and that's free on Twitter, right? Free on X?
Free on YouTube and X. Yeah, you can find in both places. Correct.
All right, Tavi Costa, again, I want to thank you, and I look forward to our next chat.
Thank you very much, Patrick. Appreciate it.
That was Tavi Costa sharing his views on the economy, markets, and precious metals. To see more of Tavi's views and work, please go to www.crescat.net. If you like this video, please do subscribe, share, and give it a thumbs up. All are greatly appreciated. Audio-only versions of this interview can be found on iTunes and Spotify.